Mode.
Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending April 6th, 2018. Boy, what a week this week was. I think we've seen the Dow. This is one of the craziest, wackiest weeks I've seen with the Dow moving over 500 points every day, up and down. Intraday swings of over 800 points, moving down, moving up. We saw the Tuesday, Wednesday, Thursday markets moving up, recapturing some of the gains, and then Thursday night, when news came out of another 100 billion in potential tariffs for China, the markets gave it all up. And then we had a really interesting day on Friday, from Thursday night into Friday, rather, with the markets finishing just slightly above the 200 EMA. The Dow for the week, I think, was down 71 basis points. That's zero point 0.7 or 0.7%. The S&P was down almost 1.4%, 1.38. Nasdaq was down a little bit more, about 2.1%. Treasury yields are holding steady, in fact, slightly up, just a little bit. So, as I told our members probably about a month ago, and certainly going into 2018, I said the markets are going to be a lot more volatile than they were in 2017. And I told everybody that and I saw this also in the journal as well. The markets are about the three T's: tariffs, technology, and tightening. And Friday we kicked it off with the jobs numbers. We were looking for something strong, but we only had a increase of about 103,000. I think the markets were expecting 180, but they did revise up prior months. So the Q1 average for jobs was about 202,000 monthly. But probably more important, the wage growth was up about 2.7%. And if you guys remember, the wage growth hit 2.9% in January, and that's what started and precipitated the big down move the end of January, because of fear of inflation rising rapidly. But since then, we've seen the yields actually start coming back down just a little bit. And we're seeing, I'm looking at the forward yield curve, and it's actually showing a move lower, rates easing going out to 2020. We're showing a couple more rate hikes for 2018, according to the 30-day Fed Fund futures, and 2019 about 3 rate hikes. But then it's showing the Fed's actually lowering rates in 2020. Now that is what the futures forecast is, and the Fed Fund futures is forecasting that, which tends to show that it's going to further exacerbate the yield curve, the forward yield curve, which would move the yield curve lower. Money seems to be kind of rushing into the front part of the yield curve rather than the back part, which moves up the short-term yields versus 10-year or 30-year, and that creates that imbalance that's moving the interest rates, or the 10-year, the yield curve actually lower. And generally, a yield curve is not good for the markets, a negative yield curve. In fact, the inversion of the forward yield curve going out in time is typically followed by an inverse yield curve. And if we go negative in the yield curve, then generally, it tends to bring about a recession in the U.S. Now, keep in mind, we've never had a recession when the yield curve did not go negative. But we have had negative yield curves where we did not have a recession, but it does tend to increase that. So just watching the interest rates. The other thing that I'm watching, which is really interesting, I was telling our members about this, but bonds are no longer really the elixir for falling equity markets. They've been that way for about 7 or 8 years. But we're seeing the beginnings of a regime change in the markets where bonds may no longer serve as the safe haven asset for falling equity. If you look at the performance in the end of Q1, we saw both bonds and equities finish lower, which is really unusual. And no longer can big money just do the simple 60-40 ratio where they keep some money in the bond market, on the longer end, because it's just not going up, because there's just no signs of inflation right now. And it doesn't happen very often. In fact, the 10-year Treasury yield is actually, it's climbed only about 10 basis points since the stock market peak on the 26th of January. Generally, in the past, when the markets fell over, the 10-year yield has dropped anywhere from 50 to 150 basis points, with money seeking safety in the debt market. But that's not the case in Q1 of this year. So this regime change can take 6 months to a year to fully play itself out. But the life of this bull market, really, if you think about it, it's been extended due to the very low yields in the treasury markets anyway. So that made, on a relative basis, treasuries and the interest rates that you could get less competitive to equity valuations. So it pushed up valuations. Currently, right now, we're going into Q1 where valuations are a little bit more fair value, to be honest. Going at the end of January, we were seeing really large valuations in the S&P, probably around 19, close to 20 PE forward ratio. Now we're getting them down around 17, 16 and a half with these moves down. And the earnings forecast for Q1 are expected to come in around 17%. So that tells me that we're close to fair value in the markets. Now, as you guys know, markets always overcorrect, both up and down. So we could still have a continued correction on a downward projection, but that just tells me that more buyers are going to start to dip their toes in the water, assuming earnings come out very good. Now, this coming week, Friday the 13th of all days, we're going to really kick off earnings, primarily in the banking sector. We're going to see on the 13th, we're going to see Citigroup, JP Morgan, Wells Fargo, PNC Financial Services Group. So we've got a lot of bank earnings that are going to be hitting and kind of kicking off. It used to be Alcoa was kicking off earnings, but now that they're out of the Dow, we've kind of shifted our focus more to the banks. And we get these key banks on the 13th, and then we go into heavy earnings season. Again, if earnings come out strong, that'll provide somewhat of an artificial put beneath the markets and support prices, assuming the tariff wars kind of settle down a little bit. Now, everybody's got an opinion on these tariffs and everything. My personal opinion is just that it's personal. I can understand what Trump is doing. Love him or hate him, I understand where he's going with this. I think eventually it's going to wind up in the WTO because most people don't realize that China is still classified as an emerging market or third world country in the WTO. And as a third world country, you get certain rights that you don't have if you're, one of the top producers globally. Well, now that's all changed over the past 20 years. So I think what the Trump administration is going to do is first work to change their classification, bring everything into the WTO and force them to do their job. If they do that, then you'll see China dragged to the table, assuming Europe doesn't get weak in the knees and backs the U.S., and then they're going to force China to play a little bit more fair. I don't think they're going to go 100%, but just being able to do that and bringing it into the WTO and getting it into kind of a formal international court will probably take some of this volatility away from the markets. And speaking of volatility, we've had, I think, 23 days just in Q1 alone, right? And we are already into just a few days in April, but I'm just counting the first 90 days in Q1, not trading days, obviously. But in the first Q1, we've had 23 days where the S&P moved more than 1% in either direction and closed that way. And that's nearly 3 times as much as we saw for the entire year in 2017. Truly amazing. But one stat that I saw that was really interesting, the average price of the S&P over the next 60 days after the VIX has moved over 20, on average is up about 5%. Now that just shows that when you have a vol pop, you generally have a correction bounce. Now we haven't had a correction bounce really maintain a level. Generally a correction bounce is just a counter trend move that we've seen, and then it rolls back over again. So let's see how all of this plays itself out. For our members this Sunday evening, we got a couple of really interesting plays that I think can, work out for us. But for now, let's just jump in. I wanted to kind of give you guys my view right now of the markets. And if you look at what I'm looking at on the screen right here, it is about going back a year or so. You can see the S&P 500 E-mini futures on the screen. And you can see there is a very wide area of this is all buying versus selling. So it's kind of where all the buying and selling is taking place and who's winning, buyers or sellers. And if I were to extend that peak out, it kind of shows you where we are right now. It's providing support for us. I've drawn some fib nodes on here of this high point right here, which I'm going to view as a pivot high, and this low point here is I'm going to view as a pivot low. So 26.79.75 and then 25.52. And you can see here that this area right here is kind of, you can call it your point of control or the value area, which is where where the bulk of the buying and selling is taking place. You can see this yellow line right here is the 200 EMA, and it's sitting just north of that area. And we were underneath the 200 EMA, but in the last half hour of the day, the markets moved back up to regain it again. So we're dancing with the devil around this 200 EMA. And we just don't seem to get any escape velocity to the north or to the south of the 200 EMA. If we move south, then I do believe this point of control area right here, and then possibly a flush out to touch the lows here, or even the lows that we made back in early February. That'd be 25.29. I didn't mark it on the chart, but that's what we are right in that area there, the 25.29. This is on the futures, all right? But I think buyers will slowly start to step in at this level, assuming we have good earnings. If we've got good earnings and the markets are at fair value. In fact, I've been forecasting for about a year now that we're going to go into a bear market, but that was before the tax cuts, before the repatriation of money and all these things that Trump wanted to do. Now with all of this, I think it'll extend our upside and the bull market, or the life of the bull market, because we're in the later stages in my mind, but it'll extend it probably another year. So I'm still in the mood for a bear market, or not the mood, but the sentiment. I see the market sentiment on this daily chart is in the mood for a bear market, or the possibility of a bear market sometime starting in late 2018 going into 2019, maybe even the summer of 2019. And it's going to be an ugly one. And you can see right in this area here on this daily chart, that was the first clue when we couldn't take out that prior pivot high. And clearly that was the all-time highs in the E-minis, but we couldn't even make it up to that point. Now NASDAQ, the fact that NASDAQ did get up and make new highs tells me that the markets are really not done with this bull market just yet. So all of this is not as much a head fake as just a readjustment of valuations based on where the market sees the reduction in the Fed balance sheet, the tightening of the money, that's the tightening piece. And then we're going to kind of work through this. Should we have good forward guidance with earnings in Q1? And earnings come in as expected, which is around 17% growth year over year. And by the way, technology is expected to come in at 22% year over year. That is going to move the markets back up and will challenge these highs here again. If we move up beyond that, then I'm going to probably expect all new highs here, and then that'll probably be the last all new high that we make in 2018, and then we're going to just kind of chop around. I do believe that we will finish up for the year in 2018, but not like 2017. Right? As I said in the stats, it's calling for, based on the going back in time when the VIX is averaged over 20, it said on average the markets will finish up anywhere from 6 to 9% for the year, roughly. So that is clearly not as good as 2017, but that'll be kind of the last hurrah that I would see in the market. So I wanted to just kind of give you my overall impressions up front, and then just go into the charts here and show you what I'm seeing. So that's kind of where I'm seeing here. Now, should we break this, the point of control, if I extend it out where the most volume occurred, was right in that area there, right? And you can see all of these are, and this is a daily chart now. These are all intraday moves lower, but the closes were up in this area here, right? So it's kind of a flush out. We've gone down low, but we've had huge buyers or automated programs stepping in and buying down in these levels and then pushing us up into the close area right in this area here. So that's kind of where we've been closing. Should we take out these areas below this point of control here, again with buyers and sellers, because that's the extension all the way out to this area here, much deeper than here, much deeper than here. But should we take that out, you can see that there is another area sitting right down in this area here, around 2490, call it around 2500 area, which is just slightly below the February lows. Now, if we start moving down that in that direction, I could see a flush out down here and then a quick move back up. But that would give us a pullback of around 13-14%, very similar to February of 2016. Okay. But I don't see us going into a bear market or a recession in 2018, not with the numbers that I'm seeing coming out of forward guidance with corporations. Again, that could all change if they make good on some of these tariffs and it starts to turn into a trade war. But I don't see that happening at this time. Okay. I see it mostly moving over to the WTO. And then hopefully cooler heads will prevail and they'll force China to do some things. So now when I put my indicators back on the screen, you can see my shaded zone down below covers the major buying versus selling here. And you can see down in this area right here, which is just south of 2500, below the 2018 low price, is our next level of support. And then we got one little one here before we give it up and go into a bear market. So I don't see that happening going into the summer months. April is traditionally a good month for SPX, but it's also a volatile month for SPX. So we got to watch this very closely. If we come in, let me just turn that off for now. If we come in and look at NASDAQ on a daily chart, you can see here with NASDAQ, again, we're holding the 200 EMA, and we're still we were in the red. Here is the 2018 price, and you can see we moved into the red, but then we closed up into the green for the month. I mean, for the day. So we're still in the green for the year for NASDAQ, but a lot of damage has been done. Okay, you can see we're between the 50 and the 200 EMA on all indexes. But the fact that we made new NASDAQ all-time highs in early March, where the last highs in the Russell, the S&P, and the Dow were made back in January, the NASDAQ was able to forge out a new all-time high. So that tells me that we're not done yet. And if technology does come through with their 22% year-over-year gains, then I think there's going to be, we're going to see a nice little bounce in the NASDAQ market. Keep in mind, next week is going to be interesting for Facebook because we've got Zuckerberg. He's slated to talk to Congress, I believe, on Tuesday and Wednesday. So he's got 2 days there. So they're going to beat him up, and it should make Facebook a really interesting daily trade. If for those of you that just need a lot more adrenaline, that'll be very interesting for Facebook. Now, like I was saying with volatility, if we look at the VIX, I do my chart in zones. It makes it easier to follow. You can see here I've got a green zone, a yellow, slightly pink, then more red, then black. Black is a black swan, right? And that's generally over around a 49 or a 50 VIX. And you can see to get into the black zone, you don't move up slow and incrementally. It's a major assault on that. Now you can see here when we go up into the black, into like a black swan kind of event, like we had in February, then what it does is it tends to create more sensitivity in the volatility market. So the markets, if they fall 20 points, the VIX is going to move up on a percentage basis higher than normal in, say, 2017, because the markets are just sensitive to higher volatility. So that means we're going to stay in this yellow zone, which generally runs from around 15 up to about 22 for about 90 days to 120 days. It takes a longer time for volatility to come back in. So for options traders, there's some really good premium to be had if you understand how to play the option market. But because we're in this yellow zone, we're subject to fits and bouts of moving a little bit higher. You can see both the 200 EMA and the 50 EMA, that goes back to 2017, of course, they're moving higher. But we're just now getting in, as I said, we're slightly above the long running average of vol. Vol should be around 16 to 18 on average. 2017 was an abnormal year. Um, Obviously, now that we've gotten vol back into the picture again, we're starting to see some regime change, primarily in the treasury market. If we look at bonds, bonds moved up on Friday. You can see the move up here. But as I've been telling my members, bonds up in this area here probably are better shorts than they are longs. Now, this is the long end of the yield curve on the bond market. If we look at the 10-year, the 10-year is not as aggressively moving up as the 30-year, right? And if I were to just look at this and then use the tools in my e-signal to plot a target point, it's saying the target point for the 10-year over the next couple of months is down around the 119 area. Right now we're sitting here at 121, so that would suggest a little bit of a down move. If we look at the bond market, and by the way, that colored bar is very good. It's basically a combination of Fibonacci extension and Gann, but it just does it very quickly. You can see my longer term support for bonds is sitting around 140. I don't think bonds are going to go too high on interest rates because the Fed's Power Ranger Powell came out, our Fed chair, on Friday, and essentially said we're going to go steady as she goes, very conservative. We're not in a rush. He was trying to calm the markets to no avail, but that's he's basically sounding like Janet Yellen, our favorite Aunt B. So that's kind of where we're sitting right now in the bond market. I would be more interested in playing it to the downside. Because when we're seeing these big, huge moves down in the markets, we do get a slight move up in bonds, but not like we used to get in earlier years because the markets are just more so on the shorter end of the curve than the longer end of the curve. They're more fearful of higher interest rates. Of course, if we look at currencies, the dollar is continuing to stay weak. You can see this huge long resistance area for the bond or for the dollar right now. Eventually, I think the dollar, as long as Super Mario continues his stimulus over in Europe and over in Japan, we're going to see money come over here to keep our interest rates lower by buying our bonds. And when they buy our bonds, they generally do them in US dollars. So it's going to keep the dollar kind of in this range, but slightly lower here, right? I know big money was on the dollar to go up. The U.S. was the only market that was into cutting back on the balance sheet. But if you look right here at the beginning of 2017, and then look at that channel we played all the way to the downside, and then we were in a short counter trend move in this channel up. We broke the channel, and then it was just all over but the shout. Back down here. I think the dollar is not going to go much lower from here for quite some time, maybe for the rest of this year. I think the dollar is going to see a little bit of strength here. Now, we've got midterms coming up in the fall time. Should the Democrats, again, we play the markets based on politics as well. Now, if the Democrats win, they've already come out. Pelosi's already come out and said they're going to try and reverse the tax cuts. They won't be able to get it through because it won't get through the Senate if the Republicans control the Senate. But just the fear of that, we'll see more downside as a result of that in the markets because the Democrats generally tend to favor higher taxes, and it tends to drive the GDP growth down a pretty good bit. So that's kind of what we're looking at there. We'll get into those discussions probably in the summer months. And then if we look at the euro, which is just counter the dollar index, you can see here we're stuck in this channel right here with the euro. So we're kind of in this sideways pattern with both the euro and the dollar, I think, for at least the next 30 days here. Because we do not have a Fed meeting in April, but we'll get one coming up in the following month. If we look at gold was obviously a little bit higher here, but we've been in this wider chop range here. You can see on my chart here with gold, I'm showing you both the 2016, 17, and 2018 highs. So we got a lot of overhead resistance to plow through here. I think in 2019, 2020, gold's going to be back up over 15, 1600. So longer term, I think gold and gold miners is going to be a good play. For now, it's extremely choppy. Longer term, if you're a longer term player, you can start to dip your toe in the water on this. I think we're subject to a little bit of down move, but I do believe longer term gold is going to be moving higher. Same thing with silver. If we look at silver futures, you can see here, this is a, let me put it on a weekly chart. You can see this pattern here on silver futures, right? Now, typically in this pattern, silver got really elevated up here. This was the short of a lifetime in the silver markets. And it wouldn't quit going down until it found fair value again. You can see on this weekly all of this volume right here. So we're almost right at the center of this symmetrical triangle. Now, typically a symmetrical triangle, it breaks in the direction that you entered it. So we entered the symmetrical triangle left to right, top to bottom. So we entered it down. That would suggest silver could break to the downside. I don't see it, but at the same time, it's a technical pattern, so we would honor the technical pattern. But I mean, you can see this as I move in, how we've just moved from high to low, and we've just been dancing with the devil on this whole thing here. We've got the crosshairs here, or is in July, the summer months of this year. Okay, so if we get an acceleration of a down move in the equity markets, then that means silver would probably break to the upside and run up here at least to the 2016 highs of 21.22. Okay, silver may be an easier trade for many because you can trade SLV, which is the stock, which is relatively cheap at 16.36 a share. Okay, but that is kind of what we're looking at on the gold and silver market. I like silver to the upside. Oil. Let's go back to the daily chart here with oil. Well, let's stay on the weekly for a minute. If we look at the weekly chart, you can see here where we're just in this wide chop range from 66 down to 58. I think the natural value here, you can see on this weekly chart when I really try and move it out, you can see there is a little bit of value here where we've had some buyers come in right in that area there like that, right? There's a little bit of an area there. And if I was to center the bulk of them, it would put them right at that level, right about there at the top part of this zone, which is around 61.50. That puts us at a fair value for oil right now, which is almost right in the center, just slightly below center of this range that we've been in. So we could be in this chop for a while, okay? Then I've got another area here of value right in this area here, which is this shaded zone here, which takes us down to about 57 even, okay? And then we've got a huge, massive area of support right in this area right here, around 47.50. So for now, I think we're going to be stuck in this chop, and then just pick a day, flip a coin, and that's what oil is going to do. Oil is also affected by the tariffs somewhat. If China is a big buyer of oil. Right now, oil is a big export of the U.S. Remember, we used to not be able to export oil. Now we do. And the forecast showed by the EAI or the EIA, Energy Information Association, or they're forecasting that the U.S. by 2020 is going to be one of the largest producers of oil globally. And because Trump has allowed now more offshore leases and to promote exporting oil, then China has stepped in to play the U.S. oil price off the Saudi Arabian oil price. Now, in these tariffs, if it starts to get ugly, China could then come out and say, we're not going to buy any U.S. oil. Right, so there could be some really interesting plays in the oil market should these tariffs play out. So this is kind of what's driving some of the volatility in oil. If we come down to a daily chart and we look at it, you can see here that we just moved below the 50 EMA, and on this daily chart, you can see there's two areas. that are equal of importance. One right here around the 6150 area, which is where my target is, and then one sitting right around the 63, 68, 64 area. So almost the range of this candlestick. That's kind of where we're sitting right now in oil. We almost got up and made new 2018 highs here back in a couple of weeks ago. But then we've just since given it all back up and we moved back down kind of in this center range here. All right. But we're still well above the 2018 open, but below the 50 EMA. Net, I think we're going to stay chopped between these two ranges here, at least for the next 2 or 3 weeks. Now, there's some other really interesting plays. For this Sunday, I'm going to go through some really interesting commodity plays that are going to go out another year or two, and you can play them either in the ETF market, in the equity market, or in the futures market with options on futures, or in the futures direct themselves. I think there's going to be some great opportunities for our members. I will go through it. If you're not a member of our group, I highly encourage you to come in and check us out. We're an international group. We trade equities, commodities, options on both, as well as stocks as well. So we just got a lot of things going on. Come on in and check us out. I think there'll be an offer associated with this email invite that you got, or if you're watching us on YouTube, you can check below and you'll probably find a couple of offers. We normally have folks coming in every week on these things. All right, everybody, have a really great weekend. And folks, members, I will see you this Sunday evening. Take care, everybody. Ciao.